Why it's important to have technical indicators in our toolbox. Technical indicators are used by traders to predict the future price levels, or simply the general price direction by looking at past patterns. They are distinguished by the fact that they don't analyze any part of the fundamentals. Technical indicators are used most extensively by active traders, as they are created primarily for analyzing short-term price movements. To long-term investors, technical indicators are of little use, because they do nothing to interpret the underlying fundamentals. Technical indicators help us identify trends and reversals. They are more objective than using chart patterns. They provide insight into the balance of power between buyers and sellers. One of the challenges of using them is that various indicators may contradict one another. Some work best in trending markets, some in flat markets, some are good at riding trends, while others are better at finding turning points. Most indicators are based on open, close, high, low, and volume. Price is primary. All indicators are basically derived from them. Many beginning traders made the mistake of looking for a magic bullet by choosing one single indicator. But markets are not that simple to be handled with just a single tool. However, using numerous indicators will not deepen our analysis, because they use the same base. In general, indicators can be divided into three groups: trend following, oscillators, and miscellaneous. Trend following indicators work best when markets are moving up or down. Their signal quality deteriorates when the markets go flat. Oscillators find turning points in flat markets, but give premature signals when the markets begin to trend. Miscellaneous indicators provide information of mass psychology. Before we use any indicator, make sure we understand what it measures and how it works. Keep in mind that trend-following indicators are lagging indicators. They turn after trends reverse. Whereas oscillators are leading indicators. They often turn ahead of prices. It's always better to combine several indicators from different groups, as their negative features cancel each other out, while keeping their positive features. As we explore different indicators, be cautious that the signals can be very clear sometimes, while at other times they could be vague. If we look at a familiar indicator, but don't understand its meaning, it's most likely because the market we are trying to analyze is in a chaotic stage. If indicator signals aren't clear, don't further interpret them, or use more indicators, but simply leave that market alone, and look for another one. As we learn more about the signals of different indicators, remember that we can't base trading decisions on one single indicator. We have to use several indicators, and combine them into a trading system. In the following section, we will be exploring the most common indicators,